Hello, everybody. Thank you for joining us for our COVID-19 update today. Our topic is your dental practice during and after COVID-19. My name is Lee Schwartz. First of all, on behalf of SVA, we hope you are all healthy and adjusting to whatever it is you call this. We've been doing our best to be a resource for dental practices all over. And today's webinar is another way in which we're trying to communicate out the latest and greatest information available. Today's presentation will cover everything we know at this point in time. Please keep in mind this information is fluid and has been changing quickly as in the last couple hours. I also want to make it very clear. If you have questions coming out of this webinar today and you're an SVA client, please reach out to your SVA professional. We want to help. If you're not an SVA client, your best bet may be to go to your existing CPA. They know your practice best. But if that doesn't work, and from what I've been hearing from a lot of you, it isn't working, feel free to reach out to me directly. We are happy to provide any assistance we can right now. This is an incredibly difficult time, not just as practice owners and managers, but just on the personal side too. The health of this industry is incredibly important to us too. And if there's anything we can do to help, we are happy to do it. Okay, our presenters are going to begin with an overview of recommendations that they've been making for our dental clients. And they're going to address some specifics of the FFCRA and CARES Act, some PPP loan forgiveness and tracking options. And many of you sent in questions ahead of time. We've done our best to incorporate those questions into our presentation. We are going to try to leave plenty of time though for Q&A, so please hang with us. To ask a question, please just open up the chat function within Zoom and address your question to all panelists. Try not to submit questions until after we've covered the topic. We want to try not to duplicate information. Also, we are recording this webinar today. You will receive an email with a link to a survey, as well as our SVA resource page where the webinar recording will be made available. With all that out of the way, our presenters today are Matt Vanderloo and Justin Chesborough, both principals with SVA in our Healthcare Services Group. Having said that, I'd like to kick it off to Justin.
Thanks, Lee, for that great introduction, and thank you for all the participants joining us today. All right, enough of these glamour shot photos. Let's move into the agenda today to talk, see what we're going to be talking about. So we're going to quickly do an overview of some of the COVID-19 dental practice recommendations we have. We get a lot of questions on this, some that we can certainly answer, others that we may have to direct you to other advisors. We're going to talk about some of the tax items, and specifically in the FFCRA and the CARES Act. PPP loan. So this is the biggest area that we've been doing consulting for. We've had, we've been dealing with our clients daily, weekly, but also we've had a lot of others of you reach out to us because you're not getting the assistance you're looking for. So we're going to go through the loan tracking. We're going to go through the loan forgiveness. We have some really exciting breaking news that just was released today about the PPP loan program. We're really excited to be able to communicate that to you. We had a little meeting before we started this webinar, and genuinely, I've actually never been more excited to present a webinar before than I am today, just because normally the timing works out where we get the updates an hour or so after a webinar, and this one worked out that we actually got an update before we're giving the webinar. So you guys are really going to be hearing about this directly, and as it's happening, very excited to do that for you, and then we'll wrap it up with some Q&A. So again, so real quickly to start out our first topic today, some recommendations for dental practices, specifically for them, the operations. So really, excuse me, when to open your doors. So we've been getting a lot of questions on that. There were some questions posted before the webinar, and we really have to, refer to you to the guidance and recommendations. Some people have made comments about what the ADA is recommending, or what the CDC is recommending. I would certainly say, well, we have to look at the state of Wisconsin first, and specifically with some of the additional powers the governor has given the Department of Health Services. What do their recommendations say? We actually have a link here on their website, and I don't want to make sure everyone's aware, they do have guidance specifically for dental providers on the website. And it really, the biggest piece or the biggest thing is they're clearly saying that dental care providers should be limited to necessary emergency services. That is the Wisconsin Department of Health Services recommendations. Keep that limited to the emergency services. If you're only doing that, you in my opinion, you should have no concerns legally. We know practically some practices didn't slow down nearly as much as others, and some refused to. There may be issues legally as far as if you expose, one of your hygienists to a COVID patient, and they would contract that. That hygienist certainly could have some legal actions against you. I know the ADHA or American Dental Hygienists Association certainly has resources and references on their websites telling their members to follow the local social distancing practices of their state and their governor, and if the practices they're working for are not, to potentially turn them in. So just know that that's out there and that is being communicated. So again, I'm going to assume that most of you are limited to emergency services right now. Got to keep practicing the social distancing and the guidelines that are being communicated. Big changes as far as into the lobby. A lot of practices going to, all right, if we're going to have these emergency care patients, well, when we have this these patients come in, well, we're going to not have them be in the lobby, and we're going to send them a text message to the parking lot when we want them to come in. That's some of the ways you're going to have to get creative in the short term, but then in the next few months, as things start to come back and we figure out what this new normal is, certainly going to have to find other ways to communicate with your patients to keep them safe. Obviously, stock up on the PPE, personal protective equipment. The ADA did come out with some Ppp guidance. I know I've talked to some of you about that, saying that yes, they certainly feel that we know there are these additional costs, so that reimbursements do have to change because of that. I recommend you all locally to reach out to the WDA to ask them specifically what they're doing to work with the big insurance payers that you may be contracting with to increase some reimbursements. Otherwise, it's truly a decrease in your reimbursement if they're not going to cover some of these inherent costs. For anyone that has fee-for-service patients, will certainly bill extra for this PPE equipment that you do have to pay for. And the ADA's guidance did say to use the CDT code D1999, which is kind of a catch-all for miscellaneous. So, use that code, bill for this additional equipment this cost, pass that on to your patients. I've had talks with a lot of different providers, and most of them are thinking of a range of $15 to $25 per patient. And that may have a scale that slides based on certain services that you're providing, as far as if it was just a smaller procedure or a larger one, could have different rates for the PPE, there. So these were just a couple of the items we wanted to quickly touch base on about some practical items and reopening your dental practice. We're going to dive into now some of the tax implications and things that are going on. So I'm going to transition over to Matt to talk about these next items.
Thanks, Justin. So there's two big acts that have been passed. The FFCRA, which is the Families First Coronavirus Response Act, and the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. So nice big titles that will condense down in just the FFCRA and the CARES Act. The big piece out of the CARES Act that we're going to get more into later, and I think where most people have the most questions and want the most information, is on the PPP loans that were a part of the CARES Act. But there are a couple other important features, opportunities in these two bills outside of just the PPP loan. So we wanted to hit on those a little bit and talk through a couple of things that might be available to you there. In the FFCRA, remember the two big pieces that came out of that were the emergency paid sick leave and the emergency family medical leave. So on the emergency sick paid leave, employees were eligible for up to 2 weeks or 80 hours of paid sick leave. They did put some caps on how much has to be paid for those employees. If they're some of your higher earning employees, you're not going to have to pay them their full wage. And they have to meet certain requirements to be eligible for that leave. They have to either be sick with COVID, under a government isolation or quarantine based on that, have someone else in their family who has it, or be at home taking care of kids because the kids aren't in school or don't have access to daycare anymore. So it doesn't apply just blanketly to anybody who wants to be gone from the office, but in certain situations it'll apply. Are exceptions, or rather exemptions from that paid emergency family leave and sick leave for small employers, less than 50 employees, if they meet a couple requirements in terms of the disruption it would cause to the business. So there are some ways that that might not apply to your practice specifically. If it does apply, if you are paying out any wages under that, there is a credit for the employer against your employer payroll taxes for the sick pay, emergency family, medical leave pay you're paying. The credit is 100% of what you're paying, and it's taken against your employer Social Security tax on your payroll tax returns. So not broad applicability to all practices, but it might apply to some practices, and you want to be aware of that. And then lots of other important stuff out of the CARES Act. There's an employee retention credit in the CARES Act. And that employee retention credit, it's on 50% of the qualifying wages, up to $10,000 of wages per person. And that's a credit against the employer Social Security taxes first. So you take it against, on your 941, against those employer Social Security taxes for the rest of this year. Any credit you have left over at the end, you get it as a direct refund. To qualify for that employee retention credit, you either have to fully or partially suspend your operations. So that would clearly apply to all the dental specialty practices out there. The one thing to remember is that this employee retention credit doesn't play well with any of the stuff under the FFCRA or against any of the forgiveness procedures we're going to talk about under the PPP loans. So these wages you're paying, it's choose one of the three, and the wages are only going to qualify under one of those three opportunities. There is a payroll tax deferral period for the rest of this year. So the employer Social Security tax that you would normally have to pay in 2020, you can elect to wait and pay half of that in 2021 and another half in 2022. So you have some ability here to defer when the cash for that employer payroll tax is going out of your practice so that it doesn't all have to come out this year to give you a little bit more cash flow this year. Again, can't take advantage of this deferral if you're using any wages to get PPP loans forgiven. So a little bit of a limited applicability there. And then a couple other ideas that might work or might be important to some practices or some individuals. The IRS has suspended all RMDs under the CARES Act for the rest of 2020. So if you're at the age where you were having to take required minimum distributions out of your IRA or your employer retirement plan, you don't have to do that for 2020. So a potential to avoid some taxable income there. And then for folks who through this disruption might need a little bit more cash flow, either to help make the practice go or to help make things go at home. For this year, you can take $100,000 out of your retirement plan as a loan from your retirement plan. That limit was previously $50,000, so they've doubled the amount you can borrow from your retirement plan. And this is kind of a neat feature. You get that money out. It's treated as a loan, so you're essentially then getting to use what otherwise would be your own cash in the retirement plan. Use it at home. You have to repay the money into the retirement plan over a period of time, and you also pay yourself interest on that. So you can get yourself some current cash flow, but still not lose out on all the benefits of that money in the retirement plan. And then this year, the IRS, through the CARES Act, is also giving people to take a $100,000 retirement plan distribution. So you can either take it out of your retirement plan or out of your IRA. That distribution is penalty-free, so you don't have to worry about paying any penalties on it. And if you repay the dollars that come out into your retirement plan or IRA within 3 years, it's also not taxable. The IRS will consider that direct rollover. So you can potentially get yourself some current cash flow, some cash to live off of right now. And if you're able to put it back into your plan in the next 3 years, it can be a totally tax-free and penalty-free event. So a really powerful way to get some money out of some sources where it would normally be locked up and not available to you until you get to retirement age, but to be able to access it now and be able to use it right now if you can pay it back. And then the last thing that came through the CARES Act that we don't have listed on this slide is the CARES Act put in qualified improvement property. So if you're in a practice that rents your space from somebody else and you've made any modifications to the interior of that space in the last couple of years, or you're going to this year or going forward, that qualified improvement property designation is going to allow you to expense that more quickly, get a much quicker tax write-off of that. So some really powerful ways to improve cash flow and reduce taxes in your practice right now. So those are the highlights from those two acts that we think might apply to some offices, but the real powerful program in this is obviously the Paycheck protection loans. So Justin's going to take back over and talk through those and some opportunities there.
Thank you very much, Matt. And one thing I just want to comment on is relative to the let's just call it the payroll credit or the family leave credit and payment that you have to give your employees for if their kids are sick or if their kids are at home because the schools are closed. You know, FMLA is in general something that dental practice haven't had to deal with because historically it only applies for people with over 50 employees. Now this law was amended to say, no, now it's going to apply for anyone with 500 or less employees. So it went from something that dental offices really didn't have to deal with to now they do. So I want to make sure that that's clear. And then when I've been talking to a lot of our clients, it's if anyone has questions about, I don't know if I want to do this or not, it's FMLA, you need to do it. And the government is subsidizing this for you. So while I can understand if you have a key employee, you prefer to have them there than be on this leave, there really is not a cost to you because the payments are being subsidized in the form of tax credits for you and payroll tax credits. So not a tax credit that you got to wait till the end of the year to get. So just wanted to make sure that that point was crystal clear. And now we can go into the Paycheck Protection Loan Program. So I just want everyone to be aware. So what are our resources? And when I say our, I mean us as your consulting team, you as a business owner. We got the CARES Act. We have the very small 888-page act to comb through. We have the SVA that comes out with frequently asked questions and answers about every week. We got SVA interim final rule, and even it makes it sound like it's one. No, they're all called the SVA interim final rule, and there are a whole bunch of different rules that all come out in different releases. So we have all of this ammunition and resources for us, but they don't all align. So the law was passed quickly. The SBA program is trying to clarify some items. So there's just lots of information out there. So I really applaud you for coming to these webinars. We're trying to get you guys quick information, but I want you to know the resources that we're using and looking at as we're putting this together. But this is kind of our toolbox for ammunition to use for that. So with that, let's dive into the PPP a little bit more. And it's clear as mud. There's more to come. The SVA, as I mentioned, comes out with additional clarification every week, if not more frequently. The IRS has come out with additional clarification and will be coming out with more. Congress is about to pass or will likely pass additional stimulus after a couple rounds of it already. And of course, then there's going to be more clarification. So we can't communicate enough just how quickly this is evolving, and you really do, as a business owner, have to educate yourself. We hope we're giving you some tools to help out here. But let's keep rolling, and we're gonna on our next slide go into some really current applicable information. So Matt and I wrapped up this presentation yesterday evening, and we were talking about SBA, specifically some frequently asked questions that you guys have been giving us questions on. That really said, okay, as part of the CARES Act and part of the SBA loans, the CARES Act suspended requirements for SBA borrowers, the suspended requirement for those borrowers to be able to obtain credit elsewhere. They got rid of that. Then they had some good faith certifications that a lot of you have been asking us questions on, and that specifically relates to, you must say in good faith that there is current economic uncertainty, and then you also have to say in good faith that there's the ability that you do not have an ability to access other sources of liquidity, sufficient to support the ongoing operations in a manner that is not consistently detrimental to the business. And no one knew what that second part meant. does that mean if I have a line of credit or if I have the ability to get a loan that I can't get this and I have to potentially pay my Paycheck protection loan back? Well, the SBA came out with frequently asked questions 46 that really helped. While the elephant is not completely out of the room, there's still some things that we need clarity on. It really helped make that elephant a lot smaller. So I have very, very good news to announce. And that is that the SBA said that there is now a safe harbor, so that if you received a PPP loan and your original loan principal amount was less than $2 million, it will be deemed that you have made the required certification concerning the necessity of the loan request in good faith. So that means if your loan was less than $2 million, you do not have to worry about economic uncertainty, which we realistically weren't concerned about for any dental practice. But you also don't have to worry about that good faith, the good faith about having sources of liquidity. So congratulations to you for getting those loans and for now having a peace of mind that you do not have to immediately pay that loan back. And the SBA, in their timeliness, they promised they'd come out with more information by May 14th. And today was May 13th when they came out with that information. So that is the huge breaking news that we're very excited to communicate to you. On the next slide here, so this $2 million piece, you know, there's times that we try to look at our crystal ball, and there's times that we get it, we're really far off, and there's times that we're pretty darn close. So Matt and I put together this information last night, and our thought was that all loans over $2 million, well, the SBA said that all loans over $2 million will get reviewed, i.e. audited. So let's just look at, I have two charts. The one on the left is the loan size for the first round of the PPP. So if you go to the very bottom row, so how many loans were over $5 million issued in the first $350 million of stimulus? Well, there were 4,412. And then there were 21,566 in the $2 to $5 million range. In the second round of stimulus so far, as of May 8th, there were about $8,000 of combined loans. So the SBA, based on them saying they're going to look at every $2 million loan or greater, already has 34,000 loans to look at. So based on their finite resources, you can see why they set this $2 million threshold. So we actually we kind of had set $2 million as a benchmark or threshold for ourselves. Well, it's very clear now that the SBA has come out with that information. So again, I just want to pause for a second, and I hope that sinks in for everyone. And I know there's lots of questions that we're going to be asked specifically on that, so we're really glad to be able to address that for you. What we want to go through next is we talked about, we want to kind of remind you about the PPP loan calculation itself and then the forgiveness piece. So I'm going to transition back to Matt to go over that.
Thanks, Justin. I think before we jump into this, the other thing that's important to know about this most recent guidance we just got from the SBA is that really for anybody whose loan is under $2 million gives you a lot of latitude and not have to demonstrate very much. It also provides a little bit of a safe harbor for anybody whose loan was more than $2 million. And says for those companies, those individuals, that as long as at the time of your application you were honest and truthful about things, if the SBA decides later on that you shouldn't have got it, you just won't qualify for forgiveness, and the SBA is going to ask you to pay that loan back. So it seems to have taken, as long as you weren't fraudulent in your application process, taken the risk of potential charges from the SBA or someone else off the table, and given some people hopefully some clarity there and some cover there. In terms of applying for the PPP loan, it's a relatively straightforward calculation on the front end to determine how much of a loan you can get. You figure out what your average monthly payroll costs were, and in this case, payroll costs include gross payroll paid for all the employees in the practice, including any owners who are actually employed by the practice. Includes retirement plan contributions made, health insurance premiums paid, state unemployment taxes paid. All of that lumps into that payroll cost bucket, and we multiply that by 2.5 times to figure out what you qualify for a loan. So really we take a look at those costs and figure what were those costs for 2.5 months on an average basis, and that's what you potentially qualify for a loan. And the clients groups I've been working with and talking with, it seems like everyone has gotten that full amount they've requested at 2.5 times. And the thought process there is, remember, we're going to talk about a measurement period here in a minute for forgiveness, but the idea behind that 2.5 times is really you're getting dollars to cover 2 months worth of payroll costs, and then you're getting that other half month is in there to cover some other costs that the practice might incur that are pretty vital that the government wanted to help you pay. Those would be rent, utilities, interest on mortgage obligations. So that's the calculation on the front end, relatively straightforward. The application was also very streamlined and very straightforward. If you could get it to work with your bank, if you could apply, it was really just a 2-page application. It should have been pretty straightforward to do. So that's the calculation side. The other thing to remember is you're thinking about payroll costs on the calculation side, and this is also going to apply on the forgiveness side, is that anyone who would earn more than $100,000 on an annualized basis, we can only look at the $100,000 in terms of the calculation of the loan amount and the forgiveness. So any owners who are maybe employed by the practice who had high salaries, we could only look at the first $100,000 of compensation for them, or any other professionals in the practice who would have pushed over that $100,000 mark. We can only look at the first $100,000. So that's the calculation. The next big piece, once you've received the loan, once you have it, we need to think about forgiveness, because that is the really powerful piece of this whole process. The loans are really nice, and it's a great way to get cash into the practice right now as you're not able to see patients. You don't have any dollars coming in the front door, and they're pretty favorable terms. It's only a 1% interest rate on the loan, so you don't have to pay much interest on that loan on a go-forward basis, and you get 2 years to repay it. So it's really a pretty favorable loan, but the real power is if we can get that loan and get it forgiven. So it's cash that comes into the practice, you don't have to pay tax on it, and it doesn't have to go back out of the practice, back to the SVA, back to the bank as a true loan. So when we start thinking about forgiveness here, there's a covered period, which is the 8 weeks that start on the day you get the loan into your checking account, your cash account, bank account, and we measure costs during that 8-week period. 75% of your forgiveness must go to costs that you spend on payroll. So that's the gross payroll to employees, health insurance, retirement plan contributions, state unemployment taxes. And no more than 25% of your forgiveness can come from those other costs: rent, utilities, interest on debt. So the first big thing to think about here is for forgiveness, the first measurement is going to be what did you pay towards those costs during that 8-week period. So if your employees are laid off, if they're not working, and if you're not paying them, you're not going to have much in costs that's going to qualify towards forgiveness, so you're not going to have much in forgiveness. You're really going to have to get the employees back in the office, back working, and start paying them again to qualify for all the forgiveness you could potentially get. Once we've figured out what you've paid in eligible costs over that 8-week period, there are potentially 2 reduction calculations we'd have to look at. The first one is based on FTEs, so full-time equivalent employees. And if there's a reduction in your FTEs, we're going to see that same percentage reduction in the amount of your forgiveness. And the way this works is you have to determine your average FTEs during that 8-week covered period and compare that to either your average FTEs between February 15th of 2019 and June 30th of 19, or your FTEs from January 1st of 2020 through February 29th, 2020. So you can look at either of those 2 comparison periods, compare that to your FTEs during this 8 weeks, and if your FTEs go down by 10%, your forgiveness goes down by, your potential forgiveness goes down by 10%. So this is a really important one to look at, because for smaller dental practices, smaller offices, if you're down just 1 FTE or even a partial FTE, if you don't have many employees to begin with, that's going to be a much bigger reduction in your forgiveness. The other potential reduction is a compensation reduction. So you're going to take a look at average compensation paid to the employees in that 8-week period after you get the loan, and compare that to average employee compensation paid in the quarter prior to when you got the loan, so that first quarter of this year. And if average compensation goes down by more than 25% by employee, then you're going to have some reduction in your loan forgiveness. So another important test, but not nearly as strict as that FTE test, because we get a 25% cushion in this compensation reduction. So you could reduce compensation for all of your employees when they come back. And as long as you don't reduce it by 25% or more, you're probably going to come out okay on this reduction calculation. But depending on the size of your office, if you're down even one full-time equivalent, you might see a pretty significant percentage reduction in your forgiveness. So this can be two things to really watch and be careful of. So that's how the forgiveness is going to work, a really powerful calculation and really important to think about.
Matt, can I just comment on one thing that you had said there? I know
Yes.
you said that the loan forgiveness, so initially you get a loan and then the loan is forgiven, and that loan for the piece that's forgiven is income to you, but you said you don't have to pay taxes on it. So it's non-taxable income, which is what the CARES Act says. However, the IRS then came out with some guidance saying the expenses that you pay with PPP loan forgiveness money is not deductible. So they've essentially wiped out that tax-free income by giving you a non-deductible expense, and they've made it a wash. However, we truly believe, because Congress has said, no, the intent of it was to truly be tax-free income. So we do believe there's going to be further additional guidance that either is an act of Congress or an additional law that says, no, IRS, you're wrong. So it's, we do believe that it will be truly what I call a unicorn, which is tax-free income. It almost doesn't exist.
Yeah, the way the IRS is interpreting it right now and instructing people right now, it would wash through your practice. You'd have non-taxable income come in, but then you'd have non-deductible expenses to offset that non-taxable income and be a net zero impact on the return. Where we're hoping they're going to get when the IRS clarifies things is we'll have tax-free income, but still deductible expenses. So there could potentially be some opportunities you'll be able to leverage there in the practice.
All right, Justin and Matt, thank you guys so much for that content and for being so up to date on everything. There were a few things that occurred to me as you guys were talking. I'd like to ask you guys some questions, but I am going to open up the chat function. So if you're listening and you have a question that we have not addressed yet, please go ahead and open up the chat function and send your question to all panelists. I will take a look at them as they come in, but a few questions for you guys first. One of the things I know we heard when the first round of PPP loans were still open and out there, there were some practices who were making a strategic decision to not take it at that time with the understanding that maybe they couldn't really put that money to good use. So kind of two questions. Number one, what do you recommend to those practices who kind of made that choice? And if you're still in that boat, if you still haven't applied for the PPP loan, can you talk a little bit about what those practices should be doing now?
Sure. So I think if you decided as a practice now it wasn't the right time initially when all this was coming out to apply and still haven't applied, I think there's definitely still an opportunity to apply. You can still apply for a PPP loan, can still get dollars granted from that. The issue you're going to potentially run into is, remember, for the forgiveness piece, there's an 8-week measurement period. The way the rules read right now, that 8-week period can't extend beyond June 30th. So if you were to apply today, get the money tomorrow, your 8 weeks is going to stretch into July. But the way it's written right now, you can only go through the end of June. So you're not going to get the full 8 weeks to expend all those dollars and try and get your maximum forgiveness. That being said, much like how we think the current IRS position on the non-deductibility of these expenses is going to get corrected, I think both Justin and I would not be at all surprised if there was some amendment to how this whole program works, so that if you get your PPP loan now, you'd get a full 8 weeks to figure out your forgiveness and you'd be able to stretch it beyond June 30th. That doesn't exist right now, but we think it's going to come. So that being said, without that potential extension, if you're thinking you're going to apply, my suggestion would be to apply sooner rather than later, so you have as much of that 8 weeks as possible to potentially get as much of that loan forgiven as you can.
Okay, great. Thank you for
that. Lee, can I add something too, as I'm seeing some of these questions come in as well? One thing that I do want to clarify that one of the members mentioned is that on an SVA webinar on May 7th, for the second part of the loan forgiveness calculation, part one being maximum forgivable amount is what you pay in the 8-week period. Part two is those reductions, the FTE or compensation reduction that may reduce your loan forgiveness. There is a protection in there that says, okay, you know, you've closed your offices, you've let staff go, they're collecting unemployment. If you do bring everyone back and restore their wages by June 30th, that reduction does not apply. Those two reductions will not apply if you bring your staff back and pay them by June 30th. I will say we certainly have some questions about what exactly that means. As far as, does that mean that you need to just restore what their salary was, which is, we believe, the intent. So you bring them back on payroll, you know, you give them their hours and you get their salary back to their regular, like, you know, weekly average salary level, you should be fine. Some people are interpreting that as, well, you've got to pay them basically however many weeks they were gone, you got to now give them back pay, which I don't think that is correct, but that's what happens when you have a law that's not crystal clear.
Okay, thank you for that. Guys, can you touch on, we've already gotten a few questions. I anticipate a few more. You talked a little bit about kind of what you need to track, but not necessarily how to track it. Can you guys address how you're recommending practices actually track this data?
Certainly. I will say, so SVA does have a spreadsheet that we have created for the loan forgiveness, but with so many questions still out there, we don't have that for distribution because there are still questions. So we can certainly work through that, you know, with our clients. And if you have questions on that, you know, feel free to reach out to us. For tracking this, in general, what I've said is I have had my clients, when possible, have a separate checking account to actually, they get the money, they put their PPP loan in there. We want to keep this segregated as much as possible. What's going to happen is the information is going to get turned over to your bank, and your bank is going to be responsible in a way for the loan forgiveness calculation. I don't want the banks to have to do that. I want to do that calculation for our clients so that we can get as much forgiveness possible. And we want to make it really, really easy for these banks. I was talking to a banker 2 days ago, and she was talking about the volume of loans and how overwhelmed they are, and how their departments internally are shifting people around to work on these loans that have never even done loans before. So we don't want to have any questions with the banks. We want to give them a calculation that's going to show as much possible. So track all of your expenses as far as you got your payroll costs, which include wages. It also includes health insurance. It also includes state unemployment taxes. That's the only tax that applies. You got your rent and utilities, as Matt mentioned, and potential mortgage interest. So track all of these either in an Excel spreadsheet in your accounting software. This is a really nice one for Excel spreadsheets. Track everything that you're paying. If you have a question on something, keep that as well. And what I'm recommending to all of my clients is, let's have a meeting at week 6 and 7 from your cover period. You got the loan. We need to connect on week 6 and in week 7 or around there to say, what's your loan amount? What have you spent? What do you have left? I mean, we want to be able to use every penny available to you and have it be forgivable. So this is not something that we can do after the fact. We need to do proactive planning to make sure that we're using this all up. And I apologize for speaking fast. I'm going to try to slow down. I hope you can tell that this is something I care about and I'm passionate. So Lee, just yell at me if I felt myself speeding up there.
I'm not, it's hard for me to yell through the webinar, so I'll just admonish you afterwards. No, thank you for that. And I think just to maybe summarize there, Justin, if I understood, I think even for those of you who aren't SVA clients, reach out. We can help walk you through at that stage to make sure you're doing everything you need to be able to do. Again, this is super important stuff, so we understand that. So Matt, you touched on earlier in the presentation a little bit about what happens if you have reductions in staff and you can't maybe get all the way to 100% loan forgiveness. So we've had a few questions come in talking about, I have some employees who don't really want to come back, whether that's because they're getting paid more on unemployment or for safety reasons. Can you maybe address how practices should be handling that?
Yeah, that's a really great question and a problem that lots of practices are dealing with. And I think the good news is that the SBA gave us some relief in one of their frequently asked questions. And the SBA has said that if you make a valid offer to employees to come back, and for whatever reason the employees say, I don't want to come back or I'm not going to come back, as long as you document everything that happened in there, you're going to get some forgiveness in that FTE calculation. So as long as you can document that when you made that written offer to the employees that they should come back, and then document that the employee has declined to return to the work, you should be able to get forgiveness on that part of the calculation for those employees. The other thing that's going to be important for your employees to know is that the SBA has said that for employees who are declining to return to work, they might start to lose their unemployment benefits. So even though they might think they're getting a better deal by not working and deciding not to work, by making that decision, because remember, unemployment benefits are only available to those who are unemployed through no fault of their own. As soon as you make the decision not to return to work, it's through your fault that you are unemployed. So those unemployment benefits may stop if you've given them a valid offer to return to work.
Okay, thank you.
And the nice thing practically is, you know, the government is giving you these funds to be able to restore those employees to their regular wages. So, you know, the government would prefer that they're working instead of being on unemployment. So even though your office may not be open full time, you're going to have these funds to be able to give them their full pay. Even if those hours truly aren't there, they may be working remotely for you. You know, that's a great opportunity for them to do continuing education from home and to get some other things done for you, for the practice. In that while they're getting paid. So it's not just paying them to sit at home. Lee, with this payroll theme, I know there were some questions about can we pay hazard pay? So the answer would be yes. So you're penalized if you pay someone less than basically 75% of what they were making pre-COVID. You are not penalized by paying them more, except for that potential $100,000 cap. So the $100,000 cap over your 8-week covered period is $100,000 divided by 52 weeks times 8 weeks, and it ends up being $15,385. So as long as you don't pay someone over $15,385, it is all eligible payroll. So you can certainly give someone hazard pay. What I will say is I've had some clients do and consider is if they have some employees that they're in a way paying to stay home, they may pay those employees 95% or 90% of their regular wage. Whereas if they got employees that are coming into the office, they're giving them maybe 105% or 100% as hazard pay. So there's been a little bit of shifting going on there, still meeting all these eligibility requirements to reward those employees who are actually, you know, coming into work.
Okay. Also, I just would love for one of you to quickly address, we've got a few questions coming in that are about like OSHA standards and the requirements, whether or not to wear masks. Probably not an area we're going to make recommendations on, but who would you recommend they reach out to for questions like that?
I think most practices should have a couple of good resources there. You're absolutely right, Lee. That's outside of our area of expertise where we want to give advice on. But for people who are looking for help in that area, talk to your attorney, reach out to the ADA, reach out to the WDA. Those are going to be 3 great resources for you on those specific types of questions, whether they're OSHA related or what type of PPE we should be using, what our new procedures should be. Those are going to be 3 good places to turn, and they're going to have great advice for you on those.
Yeah.
So, go ahead, Justin.
No, I was just going to say everything I've seen, you know, from what OSHA is saying is it's certainly, they're saying for dental practices, you know, don't do electives. That's clearly what they're saying. So for people that, again, we're not attorneys, but if you're doing more than just emergencies, you got some risk there.
Okay. So a couple of months ago, going back to when some of this started breaking, there was a lot of talk, not just about the PPP loans, but the EIDL loans as well. much less talk about that now, but I know that some practices at that time had applied for an EIDL loan as well. Can you talk a little bit about those practices that may have received both and what their options are, if any?
Sure. Yeah, I think we heard a lot about these EIDL loans right away at the beginning because that system was up and running a little bit more quickly to take applications. Haven't heard as much about those recently because that whole process has been much slower to actually get any dollars out to anyone. And we've got lots of people who applied for the EIDL loans first, applied for the PPP loan second, already have the PPP dollars and either just got their EIDL loan or haven't heard anything back on it. You can have both, so that is a possibility. You can't spend the proceeds from both the PPP and the EIDL loan on the same things. And expect to have everything qualify and not have problems. So if you're spending your PPP loans on payroll related expenses, there are other expenses that qualify under the EIDL loan that you'd have to focus on. And the other thing to remember is that with that EIDL loan, there was the potential for you to get a $10,000 grant right up front. Even if you didn't necessarily qualify for the full loan, you could get that $10,000 grant that would be tax-free money coming into the practice. If you did get any initial grant that was tax-free, forgiven, not had to be repaid, that does reduce your potential forgiveness on the PPP loans. So they are trying to integrate those two a little bit in terms of the I'm going to say free money aspect of both and limiting your PPP loan forgiveness by any EIDL grant you get.
When it comes to the PPP loan forgiveness, who's actually reviewing this? Is this something your bank is going to review? Is this something the SVA is going to review? How does that work?
Right now, it seems like the initial review is going to be by your bank. Each bank's going to have different requirements in terms of what documentation they want to see and in what format to do that initial forgiveness calculation. And from what the SBA has said, for any of those big PPP loans that Justin talked about before, anybody at that $2 million or greater, the SBA has said they're going to review all of those loans as well. So I would, at least the talk right now, the way they're positioning everything is, I would say for those loans, the bank's going to take a look at it and do the initial approval, but the SBA is going to come in and look at it behind that. So I think that's what we're seeing now initially, Lee. I can't imagine that the SBA is going to have much in extra resources to devote to looking at loans less than 2 million, but it wouldn't totally surprise me if they randomly selected a really small percentage of those to look at some point in the future.
Okay, so another question that came in, guys, was if you are under the 75% rate for forgiveness of the loan, how is that getting calculated? Is that if they spend 60%, does that mean 60% would be forgiven? Can you just talk about how that calculation might work, if it's clear?
Yeah. I guess to clarify what we were saying, so of what you pay, at least 75% have to be for payroll costs. That's relative to payroll costs compared to like your rent, utilities, mortgage. So it's not a determination of you have to spend at least 75% of your PPP loan. It's just of what you spend, at least 75% has to go towards payroll. So you could have gotten 10,000, or I'll use bigger numbers. If you got $100,000, it's not that you have to spend 75,000 of it. It's just of whatever you spend, you have to spend 75% on payroll.
And Justin, if they don't, so let's say they do get $100,000 and they spend all 100,000, but they only spend 60,000 on payroll. Is some of that going to be forgiven? How does that calculation work as far as what part of the loan is actually forgiven?
You would certainly have to pay back some of it. In that situation where you only spend 60% on payroll, you are certainly going to have a piece of your loan that has to get paid back.
Okay.
Another thing with payroll relative to that $100,000 cap. So, because we've gotten a couple questions about how does that reduction for if you reduce someone's pay by 25% impact those highly paid individuals. You exclude all employees that make over $100,000. So if you paid someone $100,000 last year, they're excluded from that reduction calculation. For the understanding of it, makes complete sense. If you have an associate that you pay and they're paid based on production, you paid them $200,000 last year, and now all of a sudden they're not producing and they're not making money for you, and they may make by the time everything comes back, they make 150,000 this year. You have no loan forgiveness reduction because of that, because those employees are excluded.
Okay. Well, another question that just came in as we were just talking about the EIDL loans. Please clarify what you mean by not being able to use EIDL for the same things as PPP. Does this mean after my PPP is gone, I can't use the EIDL for payroll?
Yeah, that didn't give a clear description of that. And I think absolutely that is not the case. So if you used all your PPP loan up on payroll and still had EIDL dollars, you could use those EIDL dollars on the next payroll. It's tomorrow's payroll. If you have both the EIDL dollars and the PPP dollars today, and you've got a payroll tomorrow, if that payroll's for $10,000, you can't use $10,000 of your EIDL money and $10,000 of your PPP loan to pay for that payroll. If you use $10,000 from your PPP loan to pay for tomorrow's payroll, you can't use your EIDL dollars to pay for that payroll as well. You can't double dip with those expenses. That's more what I was trying to say. For clarity there, we can't double dip and pay the same expenses out of both the EIDL loan and the PPP loan.
And that's a theme with everything, even the tax credits that Matt mentioned. You can't use PPP loan money and have it get forgiven and then also claim a tax credit for that payroll on those same wages. They're not going to give you a double benefit of you're going to get a tax credit and non-taxable forgivable income from the PPP. It's really one benefit for an eligible expense item.
So a couple of practices have reached out and asked about when they should take their employees off of unemployment. If their office is currently closed and generating no income, what's the best practice there for when they should actually be doing that?
I don't know if there's a clear 100% answer that's going to cover everyone there. It's certainly a conversation that we have with those practice owners to see what their goals are and what their thoughts are about their practice and when they can open. We have certainly the PPP loan, it's a real hard 8-week deadline. So you really got to pay this money out in 8 weeks. So if you use your average prior year payroll to figure out the amount of this loan, you got enough loan to cover 2 months of payroll. Why would you not start paying your employees right away? I understand some people may say, you know what, I'm okay if this becomes a true loan and I'm going to use this for a payroll in the future after, because I might be open more 10 weeks down the road. Well, then that's a different answer. If you're saying, you know what, I want to have the maximum forgivable loan amount, then it is clearly you get this money, you start paying your employees, you give them 8 weeks payroll based on what they were making before, and you're gonna, you keep the same head count, you pay them the regular wage, the loan's gonna be forgiven for you, or the vast majority of it. So we have to talk with the clients about what their goals are and what their thoughts are about this whole situation that we're in. And then from there, we can give the best advice based on the desires and wants of the owner.
I think Justin nailed that right on the head. The first big decision point when you get that PPP loan is, do I want to maximize forgiveness, or am I concerned about what, not just these next 8 weeks, but what are weeks 9 through 16 or 16 through 24 going to look like? And do I want to preserve this PPP loan cash in my practice as long as possible, because I've got some real uncertainty about what's coming up? And depending on how you answer that question initially, it's going to decide what you do for when you bring employees back. If you want to maximize forgiveness, remember that's based on what you pay in the 8 weeks following the moment you get the loan. So you got to get the employees back pretty quickly and start paying them their payroll to be able to maximize your forgiveness.
Okay, I know that's a tricky subject and one that a lot of people are trying to get their heads around. So thank you guys for that. Let's talk a little bit about, there are a bunch of questions coming in specifically about benefits, health benefits, vision, that what's included in this calculation and what's not. So guys, a couple, just even more specifically. So health insurance, employee covered health insurance versus employer versus employee covered health insurance, and then maybe some other benefits. What is included in that calculation?
So now is a perfect time to bring up that slide that has the clear as mud on it. because this is one of those things that there hasn't been crystal clear guidance. The law says that under eligible payroll costs, it's health insurance, including premiums. So clearly health insurance premiums and clearly all health benefits, as far as if you'd make company HSA contributions, would qualify. We would also, in our interpretation, or how I've been interpreting that, is I would think the dental would fall under health. I would think vision would fall under health. Is it crystal clear? No, but we've been taking that approach, and maybe now with some guidance from the SVA about what's going to get looked at or not with under $2 million, I think I would tend to have a conversation with the client and maybe being willing to be a little bit more aggressive, knowing that there's a very good chance they fall under that threshold. So that's a conversation I'd have with the owner. So one thing that they did give guidance on is the SBA gave guidance for self-employed individuals. And it was kind of they answered one question and then they created like 2 or 3 more. But this was specifically for self-employed individuals, meaning individuals who are sole proprietors and file a Schedule C. They do not have a separate corporate tax return. The SBA said, we'll give you $100,000 of wages, and even those folks don't take wages, so it's $100,000 of earned income. And if you pay your employees wages, that clearly qualifies. If you pay your employees health benefits, retirement benefits, that qualifies. For the self-employed individual, the SBA said that health benefits and retirement benefits for a self-employed individual are not eligible benefits for purposes of payroll costs. That could lead one to say, well, what about if I am incorporated and I'm an owner? Do my health insurance and retirement benefits qualify? The SBA hasn't said no, so we're certainly moving ahead with yes, that qualifies. But they did kind of, created more questions with their answer. But they were very focused on self-employed individuals.
All right, let's do a quick speed round, guys. We're running out of time. There were a couple of other questions I want to make sure you address. One is going to be specific to most of our practice owners. There's a question about if my salary as an employee is $130,000, is $100,000 of my paycheck still included in the calculation, or am I totally excluded?
You're still included, but only to that $100,000 mark. Anything you pay over and above that is excluded from the calculation.
Okay.
So take $15,385 as salary during that 8-week period because the government is paying that $15,385 for you.
Yes.
And then a few other questions that came in. Speed round: hazard pay, overtime pay, bonus pay. Are these things that can be included in the PPP loan?
I would say hazard pay, yes. Overtime pay, yes, as long as they're actually working overtime hours. Bonus pay, totally unclear. And I think where I'm going with my practices, the group of people I'm talking with right now, is if you normally pay bonuses and the things that would qualify for those employees to earn those bonuses are happening during this 8-week period, I would include it and I would pay it. If this is going to be the first time you've ever paid a bonus in your practice and it happens inside this 8-week period, I would think hard about not doing it, because if anybody ever looks at that, I think that's one that they'd look at and say, hey, it looks like you were trying to game the system here and up your forgiveness by paying all these bonuses. I don't think that wasn't the intention behind this. Remember, the intention was to get employees back on payroll. I would, if you're normally paying bonuses, do it. If you're not normally, I wouldn't think this is the time to start.
Okay.
And I might be more aggressive than Matt.
All right. Well, discuss with your advisor. All right. As we wrap up here, I would like to let everyone know that we've created a resource page on our website where the recording of this webinar will be made available later today. There's also additional information and updates on COVID-19. So bookmark svaccountants.com/COVID-19 as a resource for you in your practice. We do have a couple of webinars coming up. We're actually just putting together a webinar now to address the new guidance that came out this morning. That we'll be determining date and time for that very soon, so please stay tuned. We also have one on May 19th titled Using Data to Manage Through COVID-19 Uncertainty. You know, I'd also like to thank Matt and Justin specifically, and really the entire healthcare team at SVA, for just working so tirelessly to provide this information to our clients and really the entire dental community. Thank you guys. You have been out in front of this from the beginning. I know everybody appreciates it. I'd also like to remind everyone on the webinar that the SVA team is only a phone call or email away. And based on what I saw through the chat function, there are still a lot of questions out there. If you're an SVA client, please reach out to your SVA professional. If you're not, reach out to me. We'll get you the answers or the help that you need. Thank you again for joining us today. Hang in there and be well.